Welcome back, you crazy fool. You're back for another lesson in really hard accounting. In this lesson, we're going to start looking at the accounting for mergers and acquisition, and more particularly investing for control. So without further ado, let's get back to our friend Bob to see what Pico is up to in this lesson. A new year and new opportunities for our friend Bob. As you will remember from our first lesson, Bob is the president of Parent Corporation, or for short, Pico, a diversified investment holding company. Pico is open to all avenues of growth. Organic growth comes from reinvesting in existing businesses to grow market share or to expand the company's market. It's a valid strategy when the company has funding, the capabilities, and the capacity to grow volume using internal resources. A second strategy is to pursue strategic partnerships. And strategic partnerships have many forms. In their simplest form, they represent an agreement between entities to cooperate and jointly pursue opportunities. These sorts of relationships can be helpful when you are moving into new geographic regions, or where you lack certain capabilities, or where joint offerings add a compelling market offering to customers. A joint venture is a more formal form of strategic alliance. Each venturer contributes something of value to the joint venture, whether it's skills, capital, or assets. The joint venture pursues the market opportunity, and the venturers share the profits. Mergers and acquisitions is another common form of growth strategy that can be used to grow the business in steps. Mergers occur when like-sized entities combine to form a more powerful and/or efficient organization. An acquisition is when one company buys the business of another. This strategy is complex and difficult to do well, but it can also grow the business more rapidly than if the business had pursued simply an organic growth strategy. Bob is actively looking for an acquisition target. And Bob comes across a private company, who we'll call Eco, for lack of imagination, which he thinks represents a good investment opportunity. A business combination occurs when the acquiring company, in this case Parent Corporation, identifies and targets an acquiree, in this case Eco. There are a number of ways that Pico can go about buying the business of Eco. This is referred to as deal structure, and let's explore some of the various alternatives. The first alternative is for Parent Corporation to approach Eco and offer to purchase the assets of the business itself from Eco. Parent Corporation, in this case, pays cash to Eco as consideration, and at the end of the transaction, Parent Corporation now owns the assets of Eco and the business. Eco is sitting on a pile of cash that it received from Parent Corporation, and it's free to do whatever it wants with that cash. Another way to accomplish largely the same thing, however without cash, is to pay Eco with Parent Corporation shares as consideration for the Eco assets. Eco carries on as an owner, but only as an owner of Parent Corporation. The Parent Corporation legal entity now carries on the Eco business using the assets it purchased from Eco. A third deal structure for Parent Corporation is to make an offer to purchase the shares of Eco from the Eco shareholders. If successful, Eco, the company, and the business within the company will become a subsidiary of Parent Corporation. Pico will pay cash to the Eco shareholders, who will no longer have any interest in either Pico or Eco going forward. A fourth deal structure, similar to the third, has Parent Corporation acquiring the Eco shares from the Eco shareholders. However, instead of paying cash, Parent Corporation uses its own shares as consideration. The Eco shareholders now become a minority shareholder in Parent Corporation. So with all the various deal structures in mind, let's review Eco's net assets to familiarize ourselves with what we are acquiring. Eco has current assets of $455,000, property, plant, and equipment of $910,000, We have current liabilities of $273 and long-term debt of $390. The common stock of ECO is $182,000, and the book value of retained earnings is $520,000. Now, Parent Corporation does not have the cash on hand to pursue this acquisition at this time. Parent Corporation can either issue additional shares to new investors to raise the capital, or offer the Parent Corporation shares to ECO shareholders in consideration for their shares in ECO. Under both alternatives, it will be necessary to undertake what is called due diligence. Due diligence ensures that Parent Corporation knows exactly what it's buying. It will involve studying all aspects of the ECO business and its assets and liabilities. Due diligence varies slightly between an asset deal and a share deal. In a share deal, the acquirer is at a greater risk of assuming an undisclosed liability than they would be otherwise in an asset deal. Negotiation costs are necessary to draft a purchase and sale agreement. Asset deals are typically more complicated than share deals to execute, as they often require assignments of contracts and notice requirements of the change in ownership to various customers, suppliers, and other stakeholders. Under each alternative, there will be a dilution of Bob's ownership in PECO to an assumed 54%. Let's look at each of these alternatives separately. Under Alternative A, Parent Corporation issues new shares to investors to raise funds to complete the acquisition. To account for the shares issued, shareholder capital is increased by the proceeds less any issuance costs. The next step is to allocate the purchase price among the various assets and liabilities acquired in the transaction from ECO. The specific fair value of each asset and liability often requires the involvement of specialists. It is common that the carrying value of assets and liabilities do not reflect the fair value. After all, much of GAAP is still driven by historical cost principles. In fact, there may be certain assets, for instance intangibles or liabilities, for example onerous contracts, that may not be recorded on the books of the target company at all, that are later determined to have value. In a business combination, the acquirer, or parent corporation, has paid an amount different than the carrying values to purchase the business. The excess or deficiency needs to be allocated across the assets and liabilities purchased, regardless of whether or not they are recorded on ECO's books. Let's convert the purchase price of $1,040,000 and the information in the table presented here into an actual journal entry that we can use to see how this looks. Each line of the journal entry records the assets and liabilities of ECO on the books of Parent Corporation. Each of the assets and the liabilities are recorded at the fair value determined. The cash outflow of $1,040,000, the amount paid to ECO for those net assets, is also reflected. The due diligence and negotiation costs of $19,000 are expensed. This leaves a difference of $91,000 to account for. Any idea as to what this represents? If we stand back and consider the transaction in aggregate, we see that the purchase price exceeds the fair value of the net assets by $91,000. The $91,000 in this case represents the value of goodwill in the ECO business. Goodwill reflects the excess earnings capacity or earnings power of the business over and above the fair value of the assets and liabilities in the business. So now our journal entry is complete, and it looks as follows. Posting the entries from both the initial public offering of capital to the new shareholders of Parent Corporation and the purchase of the net assets from ECO would give Parent Corporation a consolidated statement of financial position that would look like this at the date of acquisition. The current assets are increased by the cash proceeds received from the new investors plus the current assets acquired from ECO. The current assets are decreased by the payment of the purchase price to ECO, the $1,040,000, and the payment of the due diligence costs of $19,000. Plant and equipment of $1,053,000, a patent of $78,000, and the goodwill of $91,000 are all reflected on the statement of financial position at their fair values, as are the current and long-term liabilities of $273,000 and $416,000 respectively. The common share capital in parent corporation is increased for the issuance of the new shares to the new investors for $1,040,000, net of the issuance costs of $7,000. Retained earnings, which in this case is a deficit, is charged with the due diligence costs incurred of $19,000. Let's flip for a moment to ECO's books just to see the other side of the divestiture. Now, ECO's statement of financial position would reflect the disposal of all the assets and liabilities as well as the receipt of the $1,040,000 in proceeds. The retained earnings adjustment of $338,000 reflects the gain on the transaction. This is the amount by which the proceeds received were greater than the book value of the assets sold to parent corporation. Post-transaction, ECO is now sitting on a pile of cash, which it may distribute to shareholders or use for any purposes it sees fit. Let's turn our attention to the second scenario, and that is where parent corporation offers to issue shares to ECO as consideration for the net assets. In a share deal, consideration must be given to identify the acquirer. As parent corporation controls the entity after the merger, that is, it has 54% of voting control, parent corporation is, in fact, the acquirer. Factors to consider in determining who controls the entity post-acquisition include identifying the party who holds more than 50% of the votes, evaluating the ability of each owner to elect a majority of the directors, taking into consideration any indirect ownership holdings, identifying any irrevocable agreements that provide one party control over another regardless of their ownership stake, and factoring into such calculations the potential votes attached to any dilutive financial instruments. To record the acquisition of the ECO shares, we need to set up the investment account on parent corporation's books. As we issue the shares in considerations, parent corporation share capital is increased for the shares issued to the ECO shareholders. Once again, due diligence costs are expensed. At the date of acquisition, the non-consolidated statement of financial position of parent corporation would look like this. The ECO shares would initially be recorded at their transaction amount, the $1,040,000. The current assets and retained earnings would be charged with the due diligence costs of $19,000. For internal purposes, the ECO investment account can be accounted for using either the cost or the equity method that we discussed in our first lesson. However, for external financial reporting purposes, ECO will now have to be consolidated with parent corporation. Consolidating ECO into parent corporation's financial statements requires a similar set of steps to those discussed in the asset deal structure. The purchase price must be allocated to the underlying net assets acquired by parent corporation. It's almost as if parent corporation has indeed acquired the net assets rather than the shares in the first place. Let's look at the journal entry. This entry should look familiar. Goodwill still arises as the value of the shares exchanged with the ECO shareholders was greater than the fair value of the net assets acquired. Also note we need to eliminate the investment in ECO shares, the $1,040,000, to get them off of parent corporation's balance sheet. In essence, what we are doing is we are converting one line which represents the ECO business, that is the investment account, and replacing it with all of the assets and liabilities of the ECO business itself. This perspective of the business is intended to reflect an operating view of the business, as opposed to an investment view. The underlying rationale is that because PICO controls ECO, it should reflect ECO from this point forward as if it had been running the business within parent corporation. This results in the same representation as scenario A. Let's post these entries and look at the balance sheet at the date of acquisition to confirm our suspicion. The first two columns in this table carry forward from our non-consolidated analysis. Now the third column, entitled Consolidation, is added to eliminate the investment account and record the various assets and liabilities at their fair values. The results in the final column is a consolidated view of parent corporation and ECO as if they are one entity at the date of acquisition. Before we leave the ECO deal, let's contemplate one more scenario. Let's leave all the assumptions in scenario B the same, only this time, instead of giving up 46% of the votes in parent corporation to the ECO shareholders, let's flip the percentages and give them 54% of the votes in parent corporations. Any idea as to what kind of situation we have here? This is an example of a reverse takeover. So even though parent corporation remains the parent and ECO the subsidiary, the accounting needs to reflect the fact that the ECO shareholders have in essence gained control over PICO through this transaction. Let's return to our foundational question in a business combination. Who is the acquirer and who is the acquiree? In this case, the acquirer is ECO shareholders and parent corporation is in essence the target. This changes the accounting significantly. Let's walk through this scenario. If our value for 54% of the PICO shares remains the same, $1,040,000, then the implied value of 46%, that is the 46% that Bob owns, would be $886,000. In a reverse takeover, ECO is the acquirer, who is deemed to have paid $886,000 for the parent corporation shares. Parent corporation has cash and investments with a fair value of $924. The negative amount of the purchase price discrepancy is brought into income as an acquisition gain. Let's see if we can do this consolidation. Keep in mind that even though parent corporation is the acquiree, it is still the legal parent corporation. It is only in the accounting sense that ECO is the acquirer. So in parent corporation's books, we need to record the assets and liabilities of ECO. Note that the ECO common stock and retained earnings carry forward where previously they did not. To differentiate these amounts, we will now call them new PICO common shares and new PICO retained earnings to represent this accounting perspective. The bottom half of this entry is necessary to adjust parent corporation's assets and liabilities to their fair value at the acquisition date. There was only one asset, the BICO investment, that had a fair value different than the carrying value. The shareholders' equity accounts of the old PICO must be eliminated as it's the acquirer's capital accounts, that is, ECO's, that carry on post-acquisition. Parent corporation shares that were deemed issued to Bob for $886,000 are set up as, quote, new PICO share capital. Finally, the same due diligence costs have been recorded and expensed. Let's pull this all together and see the consolidated statement of financial position. Parent company is the legal parent of the group. Thus, we start with the parent company statement of financial position. We now need to bring in ECO's net assets at their carrying values. Next, we record the deemed issuance of shares to Bob for $886,000. And finally, in our consolidation column, we need to adjust for three things. The first is we need to adjust for the assets and liabilities of parent corporation to their fair value at the date of acquisition, which results in a $16,000 adjustment to the investment account. Secondly, we need to record the gain for the negative purchase price discrepancy of $38,000. And thirdly, we need to eliminate the deemed investment in the old parent corporation of $886,000. ECO's existing share capital carries forward into the consolidation, as ECO is the virtual parent in a reverse takeover. Also look at the retained earnings line and notice that parent corporation's $112,000 deficit now gets eliminated, and that is the retained earnings of ECO that actually remain. So I appreciate that's a little bit complicated, but reverse takeovers follow the same principles as straightforward business combinations. In this module, we tackled how to account for the acquisition of a wholly owned subsidiary at the acquisition date. We also explored the mind-bending scenario of a reverse takeover. You don't see reverse takeovers every day, but they do occur. And most often, they're used as a means for a private company to go public by acquiring what is called a shell company on an exchange that is publicly listed already but has no business activities. The private company would use this type of transaction structure as a means of going public as opposed to an initial public offering. I know it gets a little bit complicated as the legal structure and the accounting structure can kind of get flipped back and forth depending on who is the acquirer. But as you can see, the accounting rules are consistently applied once we know who is the acquirer in a business combination. So I think that's enough for today. Until next time, don't stop till you get to the top. When you get to the top, don't stop.